sometimes, the market commentaries tend to use a word called it's cheap for a reason. And I think that's the case with China today. It's cheap for a reason. So I don't think therefore there is a value trap. I don't think one should get into that right now. The bond side, I think, will sort itself out much faster. The equity part is going to take much longer, because there it's not just a question of, so it's more policy, it's more about the fact that common prosperity actually goes a little bit against minority equity investors or even majority equity investors. So I would say I think wealth creation is still possible for bond investors in China, but I would be a lot more wary with equity investing.
In that respect then, because you're highlighting the prospect that it could be a value trap, but then the flip side to that is the opportunities there on a valuation basis to see some potential upside, if the sentiment's that bad. So the question I want to ask you is, if investors, according to your advice, should be eschewing China, right, because of all of the pervasive risks, where are the opportunities that have similar dynamics that they could potentially be looking at? They've got a lot of upside potential.
So in a way, like you rightly said, so this is I would say it's a bit for the brave. And that's why when we look at the more general advice we need to provide, on a risk-adjusted basis, we do not think it has the value. But doesn't mean that if you get a good fiscal program, you get a stimulus coming in the right shape, and you could have a rally in China.
Oh, no, but I was asking where else. Like, what other places are you looking for?
Otherwise, that's why if you ignore that part, then I would still say the developed markets, and primarily the U.S., remains the place to be invested in, both for bonds and for equities at this point in time. It's so well priced. In fact, investment grade globally, and especially in the U.S. markets, to some extent Europe, is possibly the biggest idea that anybody can provide today. We've never had such an opportunity in the last 15, 18 years, since 2008, so 15 odd years.
But, I mean, even if you strip out the big tech names, the S&P is valuations are at historical norms, isn't it? There's no downside. There's no underpricing that.
Absolutely. And what's always missed is when it was at historical norms 20 years back or 10 years back, whatever decade you want to take, the free cash flow generation was only half of today. So if you adjust it for free cash flow generation, it's cheap. That's the message.